Hello, everyone. This is Ed McGill, co-founder and partner of McGill Junge Wealth Management, here for our quarterly commentary after quarter number 2, 2026. And I'm with Jason Kirchhoff, who recently was just promoted to Chief Investment Officer of our firm. So we cross over $2 billion of assets under management. Jason gets a promotion on so many different fronts, well-deserved. But you told a great story the other day to the team that it's always nice to have family that will humble you even when there's good news. So tell us about that, Jason.
Well, I was trying to impress my 14-year-old daughter, which isn't easy to do, but I was trying to
No, it's
build it
not.
up. I was trying to build it up saying, I got this great new title. Would you like to hear what it is? And I told her. Her response was, so what? You're still bald. So, which
Well,
is true.
okay, you said that. That is true. And we'll try to come up with something else that does impress her. Maybe when we get to 5 billion on that side. But speaking of just family in general, there was recently a trip you went on and it created an analogy that shows up in the quarterly market commentary. And analogies are always just helpful for people to maybe understand a topic or something without, all the minutia or the real details. So tell us about the family trip, but more importantly, how does that pertain to our clients and their portfolios? Because that's what they want to know today.
Yeah, that's a great point. So we did a recent road trip to the Smoky Mountains. So it was a lot of driving, and we were using the Waze app. Have you ever used the Waze app? And it's pretty nice.
It is nice. I have it, and a lot of people have it, but it's a great app.
It's a great app. It can give you advice as far as if there's construction up ahead or a backup. It can propose a shortcut to you, which is wonderful most of the time. But we did find one time where I think we weren't the first to hear about the shortcut. So we wind up getting on this one-lane road off to the side of the freeway, along with everybody else, it seemed. And obviously the shortcut turned into a long cut. I don't know what that is. But anyway, right? So we were watching the freeway go by really fast, and we're stuck behind everybody that had the same great idea to get off the freeway.
So in reality, went with the herd maybe a little late, and it ended up slowing that path down on that. How does that concept or analogy pertain then to our clients and the portfolios that we're building?
Starting point matters, right? And there's a Wall Street adage that says returns attract assets. So you get high returns and then the assets come. But assets destroy returns. So kind of the last people in with the excitement potentially don't get those future returns that those early investors got because of the different starting point. So to take that another step further, and what I do in the commentary piece was, for example, if we look at the S&P 500, U.S. large company stocks, it's been a terrific run as of late. And I actually went back 40 years, 1985, and looked at the starting point for investors in U.S. large company stocks. And it was an ideal time to be an investor. Very low valuations. Profit margins were low at the time, but for the next 40 years, we're pretty much going to go on a 45-degree up line. Interest rates were going to start declining for the next 40 years. I mean, if you had to kind of dream up an ideal starting point for an investor, that would have been it. And now if you look today, obviously we kind of see the flip of all of those starting points. So I want to be mindful. I'm not saying that people need to get out of U.S. large company stocks. I think expectations need to take that into account, that the starting point isn't the same as it was a decade or 2 decades or even 3 decades ago. So to be mindful that future returns may not be as good.
Well, it's interesting as you mention about the large cap and how well it did, because, when we're meeting with potential new clients, they're giving us their statements. And a lot of times you will see this overweighting to, large cap equities, which on our pie chart shows up as yellow, and an individual earlier this week, about 65 to 70% of the pie chart was in yellow. And I said, well, you need more color. You need more slices of different pie in there. And, just kind of an easy, kind of comment without. So anyway, I'm just saying that. And, in reality, it didn't hurt him, previously because of the yellow doing so well and maybe not doing the rebalancing. But what's the alternative going forward?
Yeah, you probably won't be surprised to hear this, but it is broader diversification. And when we look at different asset classes such as US small cap, international, emerging markets, their starting points look quite a bit more attractive potentially than US large company stocks. But once again, we aren't saying get out. It's more of have these other exposures as well in case those future returns are disappointing.
Yeah, because we really are trying to build resilient portfolios that are based on the client's plans, and we're looking at 10, 20, 30, 50 plus years that we're going to be working with these clients and then their families beyond that. Another area that really grew, in that maybe that same time period or towards the tail end of that was just passive management. And I know we believe in both passive and active, but what's our philosophy there? Has anything changed, as we look going forward?
Yeah, it's still a great way to get exposure. And that's kind of our default when we're meeting
The
as an
passive
investment.
is.
Yeah, when we're meeting as investment committee, the first idea is what's the most efficient way we can get exposure to this asset class we want. And for the most part, it's going to be passive. It's tax efficient. It's relatively inexpensive. However, there are times where we think it makes sense to have that active manager, that discretionary manager that is making calls based on fundamentals and potentially longer term track record. So while we still think passive should play a meaningful role in many portfolios, there are times where that discretionary active manager can really benefit that long term compounding.
Does it come up in different asset classes more than others?
That's a great question because if you think about US large cap stocks, it's a pretty efficient market. There are a lot of people looking at those companies that have a strong understanding of how they should be priced. And therefore, there's not a lot of opportunities potentially for a discretionary active manager to improve the portfolio. But when you start looking at small cap, international, even real estate, I think there are cases to be made that that discretionary component can be meaningful.
Yeah, and just for everyone listening here, we have a very robust investment committee as well as just investment team, which is led by Jason and then Carson, Justin, and Burke. And then the investment committee, we had Scott and Ross that both have institutional investing backgrounds, Trent, Jack, and I think by default now, Jason, I'm on there as well too. But I like sitting in because it gives me just a peace of mind of the due diligence that we're going through. And as I was hearing you talking, it's, can we access this in a very low cost way using ETFs? And is there any benefit to the active managers? And then if there are benefits to the active manager, in what categories and what segments are we going to add those in? Because ultimately at the end of the day, we're going to look through it of the lens of just low cost, but then also tax efficiency and net rate of returns, after both of those things then too. So I think there's a lot that goes into the analysis of where we're going to put it. And then also that strategic asset location. I know your team spends a ton of time on that because our clients would typically have Roth. They typically have pre-tax accounts. So now we can avoid the taxation as it's growing. And then we'll have the after-tax account where, we're going to have to be more mindful. But wouldn't you say it's really all of those things together is what's helping us build the portfolio then?
It's a great point. It isn't just trying to pick the right manager. It's taxes. It's the location, which accounts can be the most efficient to hold different asset classes. So there's a lot of pieces that go together to get that done.
And then the last piece is you said, we're not going to get out of large cap US, that it still has a meaningful part in our client's portfolio, but maybe talk about the strategic versus tactical portfolios or maybe tilts and different things that we're doing. Because we're also not just set it and forget it either.
Right. So we will make tilts when certain metrics get to extremes, whether it's valuations or I can think of a recent example where it's more based on capital cycles. So if you look at natural resources, it was an area that was underinvested for a decade. And now we're likely to see the opposite of that. So yes, we will make tilts away from passive, away from kind of traditional portfolios, but it takes a high bar to get something like that through into the portfolio.
Well, like I said, I love still sitting on the investment committee because it just gives me that tremendous peace of mind of talk about how unique our team is, the efficiencies that we're going to bring, and also just the thoughtfulness. So Jason, want to say thank you again to you, the investment team, the investment committee, on behalf of just all of the advisors here at McGill Junge, as well as then our clients. We appreciate you and everything that you're doing. So thank you, my friend.
Thank you. I have a lot of people making me look smart. You mentioned them already, so it isn't just me.
Yes, you do, my friend. I appreciate it. And this is Ed McGill, co-founder and partner of McGill Junge, signing off with another quarterly commentary. Thanks, everyone. Have a great day.